Hey everyone, I hope you guys are doing well since the last time we talked with you. And today I have a different face with me, and this is something new that we're doing here at Creeper Wealth. We are going to start bringing in all of our amazing team members here at the firm, and we're going to be having just wide-ranging conversations about what's going on in the world, maybe about financial planning topics, really what everyone is looking forward to is just digging into the most important stuff of the day. So today I have Andy Anderson here. Andy, as many of you are aware, is a wealth advisor out of our Morton, Illinois office. He also is our director of financial planning. So we're going to have a conversation here for about 10-15 minutes and kind of dive into what's going on in markets and some of the things you need to be thinking about from a financial planning and just overall investing standpoint to make sure that you achieve your goals. But before we do that, Andy, how you doing today?
I'm doing well. It's like 40 degrees here, so that's a summer day in January in Illinois. So nothing,
like
nothing to complain about here.
When was the last time you got snow, by the way?
Oh, it's been a while. Well, we got a dusting maybe a couple weeks ago. The real snow, it's been a few weeks.
Okay. Say, I don't know if you saw this as well, but I saw it last night. They're projecting that New York City is going to get somewhere in the range of 2 to 20 inches over the weekend. It's like you guys couldn't narrow that down a little bit more.
Yeah, that's like the stock market. We might get anywhere from positive 30 to negative 20, you know?
Yeah, who knows where it's going to go, right? It all depends on what the Fed or I guess the weather is going to blow.
Yeah.
But anyway, all right. Well, hey, you mentioned the market, saying, hey, who knows where this is going to go. I think it's a great point for us to kind of jump in on it. You know, for those of you who are listening, I don't know how aware you are. Hopefully not too aware. Hopefully you're not glued to your phone like we are here every day watching the market. But the indexes have been moving, making crazy intraday movements here so far in 2022. And there are a number of reasons for that, and we'll dive into some of those today. But just from a snapshot standpoint, the NASDAQ has come down about 15% so far this year. The S&P 500 has officially touched the 10% pullback, which is the technical definition of a stock market correction. That's when an index pulls back by 10%. And so we are seeing a lot of volatility in the market. Now, some of that is related to the fact that the indexes have just gone up for 18 to 24-ish months since about April of 2020. And obviously, the law of large numbers are starting to come into play here. Now, there are some economic factors at play as well. We all know inflation is at a 40-year high, and we know that the Federal Reserve is starting to step in to combat inflation and try to bring that down. And me and John kind of talked about that earlier in the week, and so we won't dive too far into all of the Federal Reserve and quantitative easing and all that. But suffice it to say, volatility has returned to the stock market, and we think it's here to stay. So there's a ton of really interesting data points that are out there that we could talk about, but I'll turn it over to Andy. Andy, what is maybe the data point or fact that really has stood out to you so far this year from a market and investing standpoint?
Yeah, I think you already touched on it. Is the one that stands out to me is the fact that the NASDAQ has dropped, 14, almost 15% just since the beginning of this year, and that's yet another reminder that markets can move. I mean, markets can change so quickly. And what that means to me is that we need to have a plan in place ahead of time prior to that. If we're being reactionary, well, we could have sat around for a month and said, hey, do we move? Do we move? Do we move? Well, we're already down 14, 15% in that time period. So we need to have a plan in place ahead of time that we can stick to when we get to a point like this. And we'll touch on that in a bit as well.
Yeah, for sure. And you kind of talk about a plan. It reminds me of this really interesting chart that I've used in the past that kind of talks about the cycle of the market. They say market emojis, but really the cycle of emotions that we go through as investors, right? And oftentimes it feels like you're riding a roller coaster. And, there's really a really important thing to long-term success, like Andy said, is having that plan. And so what I would definitely say from my seat and from our years of doing this and having all the experience that we do, that there are a number of really important things to keep in mind in order to make sure that you weather stock market volatility and you don't make a decision because you're feeling some of those negative emotions when markets go crazy. You don't make a bad decision that really throws you off track from achieving your goal. And so, Andy, what are the things that you think are really important to keep in mind when it comes to managing your emotions and investing during periods of really kind of crazy market swings?
Yeah, so just to elaborate on what I was saying before is I think we need to have a plan in place ahead of time. We've got the Winter Olympics coming up, I think, starting February 3rd, so just a few days from now. But when I think of the Olympics, I think back to some Summer Olympics in the past, and I think of two really incredible United States swimmers, Michael Phelps and Katie Ledecky, two of the most successful swimmers in U.S. history. But what I've learned from them and what I've read about their success is that they both use a strategy called visualization, where they think about the race ahead of time. They think about, what should my stroke feel like in the third length of the pool? What's the water going to feel like if I'm behind, if I'm ahead? They think about all these things that might happen in the race so that when they do happen, they're prepared for them and they're ready for them. In the same way, with our portfolios, I think we need to do that as well. We need to look ahead of time and say, well, what could happen if the market drops 10 or 15%? How will that impact our portfolio and specifically our progress towards our goals related to that portfolio? If we think through that ahead of time and say, okay, we need to position this portfolio in such a way that a 15% drop, a 20, even a 30% drop in the market is not going to derail our portfolios. So coming up with that plan ahead of time allows us to then stick to it, knowing that we're in a good place.
Right. And, I love that analogy that you brought up of visualization. And with Michael Phelps and Katie Ledecky, they're two of the greatest to ever do what they do. But it's one thing to visualize it, and it's another thing to actually put that game plan into practice. They've had races, we've all seen them, where something goes wrong or they have an opponent who's just surging, and yet they're able to go back to their training that they visualized and then they trained and tried to execute upon to make sure that they didn't make a mistake that threw them off from achieving their goals. And so when you think about that from an investing standpoint, what are some of the biggest mistakes that we see people make whenever markets go sideways?
Yeah, I think one of the big ones is just being too active, trying to do too much. We can get to a point where the market's dropping and we say, oh man, we're not doing enough. We're just sitting here and my account's dropping. What do I need to do to get this on the right track? Well, sometimes it's already on the right track, and the fact that it's dropping is not necessarily going to throw us off. So sometimes the best move is to sit tight and go back to that plan we have in place. You mentioned if Michael Phelps or Katie Ledecky is swimming their race and they see, oh man, this person in this lane to my right is really doing well, well, they are not going to freak out and say, I need to do something different. They're going to go back to their training, as you said, and stick to that plan, and eventually it pays off for them for the most part, right? So in the same way, I think if we stick to that plan and try not to do too much, because then we can avoid what happens to a lot of people, which is, hey, the market has dropped, so I'm going to sell to avoid future losses. Well, inevitably, that's when the market turns around and goes back up. And then we wait until we get confident, and then we say, okay, it's ready. It's time to buy back into the market. Well, by that time, the market's probably already at a high point. So I think doing too much is a big risk.
Right, and it puts you in that situation where you do the exact opposite, right? Instead of buying low and selling high, you're selling low and you're buying high, and that really leads to that drastic underperformance. I really find this chart interesting where J.P. Morgan does a study every year, and they update it showing the 20-year annualized returns for a variety of asset classes. And then they put the average investor on there. With this chart, it's so interesting how the average investor is the worst performing asset class, down at 1.9% a year. And that's largely in part to what Andy just described, is trying to make decisions and jumping around whenever things get kind of hairy. And we get it, but it's one of those things that experience has taught us it's best sometimes just to weather the storm and trust the plan that you have in place. And, it's one thing to trust the investing plan and to hold your investments, so you have good quality investments, but there are also some practical things that you can do when markets are dropping to really set yourself up for success. And so, Andy, what are some of your best practices that you tell your clients whenever you're talking with them when the market's down like 10% like it is now? What are you encouraging them to do?
Yeah, other than dusting off the crystal ball, I think the best solutions at this point would be to continue making those choices and executing those behaviors that got you to this place in the first place. So whether that's making a Roth contribution, if we're going to make a Roth contribution, let's do it when the market's down. This is a great time to do that. making continuing contributions to your 401k. If we're doing that on a consistent basis and doing what we call dollar cost averaging, we're getting in at lower prices, which can then go up in the future. And also, the third one would be if we've got cash sitting on the sidelines that has maybe been waiting for a rainy day in the stock market, now is probably a great time to get that going to work for you. A lot of times the best times to invest your cash is also the hardest times to do it. It's when we see the markets going crazy, there's volatility, there's bad news in the press. Well, a lot of times that's when we earn the best return on that cash. So I think doing those things that got us to this point is a great step in the right direction.
Yeah, I agree with all those things. And one of the other things I really like to do as well whenever things are getting crazy, because as you all know, we manage money for our clients. And so we're in the trenches every day and the markets are screaming all over the place. I like to pull up a chart of the S&P 500 or the NASDAQ, and I like to zoom out 20 years. And look at how the market has performed. And there's been crazy periods of times. We had COVID, we had the dot-com bubble, we've had a lot of things happen. But when you zoom out over the long term, it helps to remind you that, hey, it's going to be okay in the long run. Stick to those good behaviors, like Andy said, of just constantly investing, especially when things are going sideways. That's a great thing to do. If you're a client of ours, give us a call. We would love to help you do that. Make your Roth contribution with our operations team. We're talking about maybe getting some of that cash that you have on the sidelines invested. Now, Andy, there's another thing. Some people are saying, okay, that's great. We know you guys manage money for your clients. So what are you actually doing right now? I think people like to say, hey, well, it's anyone can talk a big game, but what are you actually doing in the midst of this? And so we recently rebalanced some accounts. John and myself talked about this a little bit earlier in the week. We'll put a video snippet of some of the things that we're doing from that video that went out to all of our clients, so you can get a sample of that as well in the body of this email. But Andy, I want you to talk about what I think is a really, really critical conversation right now with the Federal Reserve announcing that they are raising interest rates in March, and that is what the impact is going to be to bonds. Well, a lot of our clients have target date funds in their retirement plans through their employer, and they are automatically allocated to bonds. That's neither good nor bad. It all depends about your goals, but there are going to be some large impacts to you if you do have bond investments inside of any of your investment funds. So Andy, kind of walk us through this chart here showing how bonds are performing currently and what some impacts may be on the horizon.
Yeah, so generally we view bonds as a lower risk alternative, right, compared to stocks. Sure. Thinking that when we hit times of volatility, those bonds are going to kind of smooth out the ride and give us a little bit better return over time. But as you mentioned, over the last year, it's kind of been the opposite of that, to where bonds, although they may have been less volatile than stocks, the rate of return has also been quite a bit below as well. And some of that has to do with how bonds behave. And what we see going on with interest rates, what happens when interest rates rise is the value of our bonds actually declines. So the fact that we've seen interest rates talk about going up in the future, that has really impacted the price of bonds over the last year. So you can see here the S&P 500 has gained over 15%. In that same time period, the bond portion of the portfolio may have lost over 5% in that time period. So we have to look at what are some other options out there. What are some other tools we can use to get that same impact of risk reduction without having that same risk of losing value in the investment. So we have different tools we use, whether it's a buffered ETF, which provides a certain level of protection on the downside with stock market-like potential on the upside. Tools called a fixed index annuity, which may completely eliminate loss from the stock market while again also offering stock market-like upside. So there are definitely tools available to us that can give us that risk reduction capability, but may not come with the same risk as we venture into time periods with rising interest rates.
Right. And all those tools, it's great to have a full tool chest, right? But one tool, a hammer, may not be the best tool for the job. And so it's important to make sure you talk to a trusted advisor, someone that knows your situation and your goals, to help you pick the right tool for what you're trying to achieve. And I think Andy laid it out perfectly there. And so, hey, before we sign off here from this video, I really kind of want to get what you're thinking about and what you want to tell everyone to keep in mind as we move forward during a period of really volatile markets. What would you encourage everyone to keep in mind?
Yeah, during times like this, I go back to my childhood And my grandma always had this saying, you may have heard it, but she would always say, "This too shall pass." And it's when you're going through those difficult times, it's like, man, this is on my mind. This is impacting my day to day. And it's, hey, this too shall pass. So we'll get through this. And I think that's important to remember, because if we have a plan in place for when markets get turbulent, for when it may seem bleak and we question whether we're on track for our goals, if we remember that that plan is in place for a reason, can help us reach those goals in the most efficient and effective way possible, then I think we're all able to keep in mind that thought of, hey, this too shall pass.
I love that. That's awesome. That's awesome. I think I almost needed that reminder today. So it will pass, and we will be here through it no matter what, to help each and every one of our clients through this. And if you're not one of our clients, hey, we would love to talk with you. We offer a free consultation to everyone that we work with. So give us a call or shoot us an email. Andy or myself or another one of our team members would love to engage with you and try to answer any and all questions that you may have. So that's all we have today, guys. We appreciate you and your time, and we look forward to talking to you soon. Have a good one.